Yes, good morning. Yes, and thank you so much for joining us today. So we are going to talk about investors and investment opportunities and what is attracting investors to invest in alternative and receivable finance. The world has changed tremendously in the last couple of months, and relative value offerings, propositions, risks have changed tremendously. So I'm really excited to speak about this. And last year at the same time in November, I was standing in a conference and I said that please note the most important takeaway that we cannot predict risk. And I had no idea that I was so right, two tail events in the last 2-3 years. So very excited. Before we start, I would like to ask my very distinguished panelists who are expert in this subject to introduce themselves. Maybe we can start from left to right.
With me?
Yes, Martin.
Welcome. Can you hear me? My name is Martin Opfermann. I work for Allianz Global Investors, where I head up the trade finance team. The team itself manages our working capital funds, which we have launched a couple of years ago.
Bertrand de Cominges in English, Santander Asset Management. I lead the trade finance strategy on the private investment company of the group. We currently run 2 funds that provide weekly liquidity on trade finance assets, and we are launching a new high yield fund, trade finance assets in January, February.
Afternoon, Rick Pearson. I'm the CEO of Pactum. We're a Swiss boutique. We've bought about 7 billion euros of receivables over the last 3 years. We specialise in sourcing large portfolios, wrapping them, securitizing them and placing them onwards, and we also do a lot of securitization just as a service as well.
I am Francesco. I'm from Fasanara Capital. We are an asset manager. We manage around 4 billion. We have been around for 11 years. Prior to this, I was in banking for 15 years. We have a range of strategies, including trade receivables. In addition to that, we do consumer loans and also more data-driven strategies, including also cryptocurrencies.
Thank you, and I'm Sean Edwards. My only paid job, there's quite a few jobs up here, my only paid job is as a lawyer. I apologise for that. But I have a more commercial role as an advisor to our trade finance department in SMBC, but principally I'm going to be speaking today as chairman of ITFA, and you've already heard from the last panel some of the work that ITFA's doing in credit insurance. We have a very large committee. I'm also going to be talking to you about the work we're doing in funds, in trade funds. Thank you.
Excellent, thank you. So we have 3 subjects to discuss today. The first will be about last couple of months, how you survived, what happened to you, what are the trends you observe. The second subject will be about relative value in the context of rising rates, rising inflation, uncertainties, and some public market instruments repricing significantly and offering very attractive opportunities for investors. And the third subject will be new opportunities, including standardization, what will happen next year, what is the role of ESG in this context. So let's start with the first subject. What's new? What happened in the last couple of months, and how do you observe the market trends in terms of volume, in terms of pricing, in terms of liquidity? Shall we start with you, Martin?
Yeah, why not? So this year was marked by a lot of capital market volatility. So and it was one of the worst years for investors. And when I say investors, I mean the people investing into our funds, not the asset managers who sit here, but the people who invest, so pension funds, insurance companies, family offices, and the likes. It was the worst year. Why? Because historically you could always balance a portfolio 50% equity, 50% fixed income, and it all worked out. If equities were down and fixed income was up, and it all works out. Over the past 100 years, this was one of the 4 years where you had minus 20% plus, minus 20% or more loss on your portfolio on both sides. So the correlations between asset classes, and that can include commodities, include risk-free assets and so on, was phenomenal this year. It was out of the norm, it was out of history, and that's where everybody who invests money struggled with. The good thing here for this asset class was we were always pitching a low correlation asset class with a lot of liquidity. And people kind of nodded when we made these pitches in the client presentations. And it was like one of those slides where you just flip over and it goes to the next, because every investor hears a lot of pitches from asset managers, and low correlation is always a good argument. But I think what's special this year is we actually proved it, that it is uncorrelated. It is like cash plus something. Yeah? And there is obviously risk involved, but it's not clear cash, but it behaved in a portfolio context very much like it. And that is something that investors start appreciating more now that we've seen it.
But isn't the same for all alternatives, like private equity, private debt, direct lending, other alternative asset classes? So these were the uncorrelated asset classes.
Historically, yes, but the question is, is the valuation updated? Yeah. I mean, anything that is not valued is uncorrelated until it's valued, right? So
at least you have a self-liquidating asset class.
Just because, I don't know, private equity values only once a year, and with a lag, it doesn't mean that the multiples in the equity markets won't affect it, right?
Yeah.
So they're just coming down later. I think what this asset class has is it has monthly or weekly updates in prices, and it shows it's
we run several private investment strategies, and we have received a significant inflow of assets under management from others due to that uncorrelated perspective. The cost of debt has increased dramatically since the 18th of August, really, when the Euribor 1 month finally became positive. But we've seen that as well on BBB debt rates for corporates globally. And in the case of trade finance or receivables finance has maintained quite stable, completely uncorrelated. The other day with an investor, also our investor, the performance of the fund. And of course, the performance of the fund is very linear, fantastically. So he actually asked, okay, where is it? Where are you showing to me? There is no chart here because there is no fluctuation or anything. That is attracting that, because it depends the word you play. At the end of the day, in the sub-investment grade or investment grade. Our two investment grade funds really compete against money market funds, against liquidity or structured notes, for example, from specific houses.
So you provide an alternative for cash with visibility for self-liquidation and ability to read price risks.
Indeed, correct.
Yeah.
And allows our investors as well to position that cash whilst they wait for the right moment, situation to invest in other alternative asset classes.
I think that's very much what we've seen is investors, Martin's absolutely right, this volatility actually generated a huge opportunity for our space. The problem now, which is, as a panel, hopefully we're here to address today, is how do we educate those investors? Because, unfortunately, we're in the previous panel, the big G word came up several times. I mean, certainly we're sat in Switzerland. That is not helping anybody in Switzerland sell anything. I mean, it hasn't been up till now. Luckily, we now have the book of the story of the fraud, which is out. People are reading it. They're educating themselves. They're beginning to understand, but we have spent most of the last years starting every pitch with, why are we not Grinzel? And I think now, as Martin said, we've proven our non-correlation. We've proven not just non-correlation, we've proven how close we are to working real-world cash flows. And I think that's what people want to put their hands on right now. They need something tangible. They don't understand what's going on with the bond markets. They don't understand where equities are going next. They don't know if there's going to be a recession next year. We don't really know when rates are going to peak. So where do you put your portfolio? And again, as Martin highlighted, 60-40, 50-50 has always been the go-to. That's got buried. And now that investors have got a little bit of a headless chicken thing going on, and we're seeing huge numbers of inquiries. But the problem then is the varying levels of education within those investors, from family offices that come to be educated to the large institutionals who come in with a pre-plan which doesn't fit what we do. And that's going to be our challenge.
And it's very difficult to be open-minded as an investor when you have all the portfolio going down, yeah?
Exactly.
We have entered the area of fear, and I mean, what I would like to add from my perspective on investors, I did see that they had a lot of liquidity issues, margin calls, posting collaterals. So even large institutional investors, they openly admitted in conferences that I attended in the last couple of weeks that they had liquidity issues. So they can't invest. They wanted to see how the asset classes are performing. And secondly, because of the decline of both bond and equity, the relative proportion of illiquid asset classes have increased. So they have reached their plateau. So these were the two issues I experienced as a sort of bottleneck to take advantage of these opportunities in addition to that. So do you have something to add, how you experienced, what are the trends you observed?
Well, in our experience, talking still about correlation, it is very true the asset class is very uncorrelated and it behaved incredibly well during a year like this, and it proved the point. It was a validation point. The flip end to that, which requires a lot of education, like Rick said, is that it was a very good, our performance during 2020 when there was this linear target of IRR and yields delivered to investors at a time in which bond yields were going down to zero. This year we received from the investor base a bit of pushback because yields have increased. And so all of a sudden uncorrelation comes also as a disadvantage to some extent because we don't catch up on yields as quickly as other asset classes. And so the education point is making sure that they compare apple to apple. And so, for example, like in a year like this, they compare us in total return terms and not yield to maturity, because the total returns we are much above, public bonds, also on the short end, also on the investment grade space. Whereas when you just look at yield to maturity, our alpha is less than it used to be, and like the education, is about compare us with the right things, and give us a little bit of time to adjust spreads on LIBOR. And compare the total return of 2023 of the public bonds against ours, and not, just try to do the right type of analysis.
Yeah, very true. So do you have something to add?
Yeah, well, I'm just looking at it more. I mean, we've got some great asset managers on this panel, and you're doing well. You've obviously, your business, your investors, you can explain it to them. You're not in the G word has come up. Unfortunately, I've just finished reading that book. I'm actually quoted in that book anonymously as an industry voice, a report we produced in the Global Supply Chain Finance Forum. But there is, if you look at from the wider point of view, people who come to trade for the first time, they see something that's not bank intermediated, where there's a lot of open account, and they see opportunity. I advise some startups, and they think, wow, great, we want to set up supply chain finance fund, and there's so much opportunity here. When you start looking into it, of course, it's a lot more complex. The type of assets that the trade finance world consists of is extremely variable. The safest to date, up to now, what was perceived as the safest kind of asset, the payables or the reverse factoring, payables finance, as we like to call it in the Global Supply Chain Finance Forum, that was seen as the safest because it's a confirmed payment. But then we've got the G scandal broke out. And suddenly we find, and if you read that book, and it's a bit of a shame, actually, because the industry, I think, had got over that. I'm going to be on a panel in about 2 weeks with the author, and I'm told that that panel is so popular that we've had to be promoted to the main stage of this event. And I'm sure it's not because I'm on the panel. It's because of Duncan Mavin, who's the author of that book. There's a lot of prurient interest in it. It's unfortunate, as I say, because the industry, as an industry, people in the know, had moved on, I think, relatively quickly. Yeah. We published in it for a reaction to that. And so now we've taken a bit of a step back because, again, it's in the headlines. But if you look at things like, the trade finance gap, it's gone up from 1.5 trillion to 1.7. There's a lack of understanding about what the assets are. The safest one, as I said, now seems to be not so attractive, so we have to re-educate people on that. We'll talk about standardization later on.
How big is this industry actually?
Sorry?
How big is this opportunity for investors? You know, we started, I mean, I have been in this market for almost 3 decades, to be honest. We started with leverage loans, direct lending.
All right, so if you look at the trade finance gap, it's 1.7 trillion at the moment. So here I'm quoting from the ADB and the latest, to go back to the point that we've all made, that trade is a very safe asset class. We've had the latest ICC Boston Consulting Group report showing that default rates in last year, 2021, were lower than the year before. It's a very safe asset class. If you're looking at things like import letters of credit, you've got 0.01%, export letters of credit, 0.01% failure, all right, on supply chain finance, which they mean payables finance, 0.1% failure. These are really safe asset classes, absolutely underpinning what we say. But what are the figures? I mean, it's a private market, so no one really knows, but 1.7 trillion is the trade finance gap. According to the ICC BCG, there's 55 billion of trade finance. So do the maths.
In my understanding, it's around 18-20 trillion, because somehow everything is linked to trade, you know. So the total balance sheet of the banking sector is around 35 trillion in Europe. So you can really see in the context that, you know, everything somehow has to do with trade and financing the trade supply chain. And, you know, if I look at the leverage finance market or the high yield bond market, we are talking about 1 or 2 trillion. You are talking only about 1 or 2 trillion financing gap. So it's a huge opportunity, it's a huge market, but it's also a difficult market.
Absolutely.
In terms of understanding of risk, structures, complexity,
so risk, I hope is okay, but risk.
Yeah, no. And that just to back what Sean was saying, I mean, the reports state, and what we're seeing empirically as well, is, you know, defaults are just not happening. As I mentioned in my introduction, we've bought 7 billion euros worth of receivables over the last 3 years. We've never had one invoice more than 2 months overdue.
Excellent.
Not one. So
amazing.
So there is.
Show the same figure for leverage loans. I can't show it.
No, I'm probably
direct lending not.
No, I imagine not. But that's that says that there's quality portfolios out there.
Yes.
But our problems beyond the education are now, obviously, as the chaps mentioned, the sticker shock with rates. It's going to those portfolios, going to those corporates, and saying yes, as was mentioned in the panel yesterday. You know, a double A corporate now lends where a junk bond corporate was borrowing last year. And going to a treasurer and saying, yes, I know if you'd done this last year, you'd be doing it at 3%. Now you're doing it at 7%. There's a sticker shock, and the industry will need time to go beyond that.
Yeah. Also, this is a jurisdictional business.
Yeah.
You know, at the end of the day, you run operations in 180 countries. We buy assets in 68 different countries today. But you need the right specialization, understanding of the legal framework and others. That is quite complicated. There is not, unfortunately, an easy agreement you can buy and you can put together for a repo. This is much complicated.
Exactly.
There is a standard framework that is complicated, that every single leading institution has make it even more complicated if possible, and sometimes it's difficult. But
and of course the board sees some newspaper articles that BNP is exiting financing or ING or whatever, and they you know, but you see this news appearing that trade finance institutions are exiting, so they are asking themselves, why should I, as a pension fund or insurance company, enter into that? So you always have these discussions in the context of defaults as well.
I think in terms of capacity, what you've seen is a lot of banks exiting the commodity trade market because of the frauds in Singapore. Yeah. That capacity has been filled in partly by the bank for which I work. We took over a lot of that business from one of the Dutch banks. That is the business actually at the moment that's very high quality. I talk about commodity traders, but it's low yield because it is high quality. But what another factor that's happening, and actually this is again another opportunity for funds. If you talk about mainstream bank finance, a lot of that, because of inflation, because of price inflation in commodities, especially energy, a lot of that is getting sucked in to financing, you know, the higher costs. So inflation is taking out a lot of that finance, but that doesn't help the 1.7 trillion gap. And we're not here to talk about helping SMEs. We're a little bit here to talk about how we're helping ourselves, but we can also help them. There is the opportunity. I think the point about pricing is key.
Yeah.
As we talk about, there is a lag in this, and I see this in my own bank as well.
There's a lag.
Yeah, there's a lag in feeding that through, I think.
Perfect opportunity to speak about relative value, where we are today. Yeah? So basically, the market is repricing risks. Investors can pick up public market opportunities, like triple B CLO tranches at 12%, high yield bond 8%, government bonds, triple B investment grade 5%, and they look at us, look at you, and they say, okay, what can you offer in the context of risk-adjusted return in comparison with other asset classes? I would like to ask with you, Francesco, how do you see the relative value offering of this asset class? Because you have such a broad exposure to various asset classes.
So I see it as still very, very attractive from a number of standpoints, especially if you're able to compare it with the right things. There are a few features to the asset class which are really very advantageous, especially in a market environment which is so uncertain as the current one, uncertain and volatile. Short duration, ultra short duration, because we deal with an average duration of 2 to 3 months is one. So the asset class is self-liquidating. This is an important feature because at times in which things change so dramatically, so fast, you may decide to change your allocations dramatically on a quarterly to semi-annual basis. This is a big point of, is a luxury situations to be in. Let's think about, for example, during the pandemic, the asymmetric shock that represented to Italy and Spain, hit very early during the crisis, to the retail brick and mortar sector. So the ability to reshuffle your portfolio and move away from those risk spots was advantageous. Second is the fact that the portfolio lends itself to a very high granularity, which means a high diversification. That is also very advantageous because you can avoid as much as possible idiosyncratic risk, single obligor risk, which during an uncertain macro environment can kill your trade, right? Because if you are unfortunate to find yourself in a few defaults, and those few defaults are enough to tip the balance, then that's not a great portfolio, right? I mean, it's not a very resilient portfolio.
Excellent. Can we pause here for a second? I would like to ask the audience, in comparison with 2 years ago, do you think that the offerings of our friends here at the table, receivable finance, trade finance, became more or less attractive for investors in the context of other investment opportunities? So where are we today? Is it more attractive? So please raise your hand who believe it's more appealing, more interesting. Would anybody feel free to share if you think it's less attractive? So raise your hands if you think it's less attractive in comparison with other investment opportunities than 2 years ago. Okay. Would you mind sharing why you think no, and maybe if you are okay with that?
I mean, I can't comment particularly on kind of yield investment stuff. I agree that the green stuff has not helped at all. Just purely from a kind of a bank perspective, the majority of the questions you get asked are about green seal, and it doesn't actually go into, a lot of the time it doesn't go into the detail. It's just like a kind of allergy where people think that, as soon as you have that, then the market is terrible. And yeah, it goes to the point that the panel was saying in terms of you need a process of re-education where, you understand actually it's not so bad.
All right, anybody who would like to share why it's more attractive, what we haven't mentioned yet?
Thank you. I think it's also because it's related to the real economy, basically. So you touch base to the real goods, the real shipment of goods and services. Not saying that the other asset classes are speculation only, of course not. But you are down to earth. And I think it's a very stable, predictable asset class. Of course, the yield is respectively a bit lower. But for investors, it's very much attractive, especially with volatile markets. So this would be
I think if you just see
I think there are
value.
two characteristics of this market that are very unique. One is the short duration, meaning it's less exposed to some macro things like interest rates and things like it. And the second thing is more diversified. Because if you go, for example, on real estate, you are exposed to one segment. Here, if you look at portfolios, you have every industry, you have all the different things. So a combination of diversification and short duration is basically what makes this market much more attractive.
Yeah, I agree with Igor. The two facts. In our Euro fund, we've been providing weekly liquidity, paying 35 bips on A minus risk, single A risk. Any bank out there will be charging you between 50 and 100 bips for holding euros in their bank account during a long period. We have increased returns 400% in the past 3 months on our single A risk paper with weekly liquidity. That is unbeatable. Then you can get into high yield, but that is unbeatable, especially when what you are funding is the real economy.
And please mind my statement, what I said, that insurance companies, pension funds need liquidity.
They do
They
indeed.
need liquidity now. So the attractiveness of this asset class is its ability to redeem.
Yeah, but this is where Rick mentioned before. Now we need to educate and change the standards these very industries have on that liquidity treatment, because the patterns they require sometimes may not be achievable by the trade finance industry that originates the assets.
I think we should also be sort of defining a bit what relative value means. I mean, if you just look at margins or spreads or whatever they're called in your market, you just say, what am I earning on this? And I'm comparing this, then it's true, the relative attractiveness has deteriorated. And this is simple because the trade finance working capital world hasn't moved much. But the high yield and the investment grade bond markets the spreads have widened quite a bit.
So why did you raise your hand when you said less relative value?
No, the point is I'm not using that definition because for a very simple fact, yield does not equal return. Yeah? Why on earth should I buy 5-year duration or 10-year duration today and commit sort of to that duration point when central banks and the whole curves are still shifting upwards for the next year?
Yeah.
And it's all consensus still. So why take that duration risk? The other thing is it's a luxury asset class. We don't have to pick the winning sectors over the next 5 to 7 years. All the other assets out there, they buy today and then they position for that industry, for that sector, for this segment, and then the economy and the recession strikes, and we'll know 5 years later what it is. We're just watching the next quarterly report and rotate out or in. And that's the beauty of this asset class. And that's for me value, but it's not reflected in this price. Yeah.
No, correct.
But you know what you say is very true, because my question was linked to relative risk-adjusted return. What we say is value, and value could mean many other things than return to investors. It could mean liquidity, it could mean diversification,
Absolutely.
and it could mean also protection, because if your capital charges have 100% for certain asset classes, or you can get capital relief, and this is, I'm looking at you, Rick, this is also value, because your risk on solvency is very, very high, and that's a very interesting market for insurers still.
No, absolutely. But what we tend to see at the moment, Gabriella, is more a situation where investors, they had their big hunt for yield and they were buying riskier and riskier assets to try and get some sort of return on their books. They've got hurt on that strategy. And now they're turning around and saying, hold on a second, we can get 3-4% in a decent government bond in Europe. Why don't I just hold that for a bit, because everything else I was looking at wasn't a great plan. And I think that is where we are right now, and I think we move on from that very quickly. But I think that's just where the sector we're in right now.
I think, Bertrand, what you said was very, very true, is that you need to compare peer with peer and apple with apple. And you rightly said that, my asset class that I'm responsible for this specific segment, I compare with this tenor of treasury bonds, It's not fair to compare with direct lending. It's not fair to compare with consumer finance, because it's a very different risk.
But I think one of the problems is, what is the trade finance apple? Is it actually an apple? Or is it
It's
a
not
variety of,
multiple
because there are so many different potential assets, and this is what's really unfortunate about the Greensill story. And I in a way, I'm glad that it's a great book, but unfortunately, it's raised this point again. As I said earlier, I think the industry had got over, but investors have not. It's now back in their sights, as you were saying, Rick. But I'm interested to know, Bertrand, why you're setting up a high yield fund at the moment. Is it because of this?
Because of demand. Basically, multiple of our investors have requested us to do what we are doing into a higher yield environment.
Because the conventional safe asset is not yielding.
No, because they never were explained that trade finance is not an asset class, it's multiple asset classes with plenty of opportunities out there.
Okay, that's
managed
so you're
rightly,
actually extracting out the risk or the higher yielding bits, not call it risky, the higher yielding trade assets, and putting it into a separate fund.
Yeah.
Okay.
Indeed. No, actually not. We are building a new strategy into the higher yield.
So you have lots of different apples in your basket. Is what I'm getting at.
Yeah. Well.
So I think
a lot of different fruits he has, not only apples. A lot of different fruits.
Yes, bananas.
And how can you compare in an 18 trillion industry, or if you're a bank, it's not for nothing that you have specialization. So it's an asset class which requires specialization, knowledge, expertise, and that's why we are paid. Because if it wasn't, then you can buy government bonds on Bloomberg,
But it requires as well education, and it requires the trade finance industry to adapt to the opportunity. Because in my view, and I think all of you share my view, if the trade finance industry enhance its paperwork, its mechanics, its sharing of data, this will be a massive opportunity accessing the secondary market and specialized investors in a much bigger environment.
I mean, the best way to compare peer with Apple, if you know the price and if you know the taste and what it adds to you. I mean, that's what you are saying. In order to compare, you need to know the price and you need to know the value, which is extremely complex. And I have been dreaming about it in the last 20 years or 25 years that we will have standardization to be able to compare return PD and LGD, but the industry has a lot of limitations, and some people actually do not really want this level of transparency in direct lending.
I think standardization, as discussed on the previous panel for the insurers, it's not happening. I mean, there was a big panel last year where there was a 1 hour debate on standardization, and the conclusion was we aren't going to go to standardization anytime soon in receivables finance, because every deal is different. Bertrand's buying assets in all these different countries. Every single one of those countries are going to need legal opinions, true sale opinions. I mean, you are never going to come up with an ISDA. I mean, no matter. And it's just not on the horizon for what we can see. Fortunately, our hosts here put together some very good documentation so we can start out from a good base. But there isn't going to be standardization in a hurry here. And that also doesn't help with the education of investors, unfortunately, because they simply see the complexity.
Yeah, but look at it in the context. 20 years ago, when I pitched for institutional investors about leveraged loans, it was education. Education. Right now, it's a standard mainstream asset class, and they are even doing it themselves. Trade finance as an asset class or receivable finance is still new, and I think it's a lot bigger industry than leveraged finance industry, and I think people should see the beauty of it in the right context.
We always tell investors, if you get confused by all these names, receivable finance, reverse factoring, confirming, and so on, then you're in good company, because nobody really understands which one is comparable to the other. We try to bring it then down to sort of risk factors. What bundle of risks are you taking? Otherwise, you can't really explain it. I mean, it's just then the next asset manager comes in and calls it reverse factoring, and the next one comes in and calls it. It's as an investor, it's just not possible to understand it.
This sort of Tower of Babel problem is exactly why the Global Supply Chain Finance Forum was set up. And I remember when we had our kickoff meeting, there was somebody from a very big American bank who said, I will call it what my client calls it.
I was there.
Was that you?
Okay.
No, you.
It wasn't me. It wasn't me.
You were there. I will call it what my client calls it. And there's a lot of people who see opportunity in obscurity. you know, in finding the niche.
But the definitions don't say, do you take fraud risk? How big is your ops risk? What's
Correct.
what's
So
the
all the-
legal risk
there's-
around
there's a
it?
whole lot
How
of
have you
other
gotten around the wrinkles, right? And so we're trying to
We
bridge
are
that
confusing the audience. You know, this is going to be worse for the
Well, they won't be
class.
confused with investors, certainly not.
Yeah, but you know, this was settled down. I mean, 15 years ago when somebody asked me what is leveraged loans,
Yeah.
I couldn't define it, I still can't define it. And by the way, nobody in the industry can define it because it's actually not definable. Yeah? So relax, because at the end of the day, what really matters to investors is trying you out, try it out, show good performance, and then they will not have any questions like that because they will understand the beauty of it.
Yeah. Perhaps,
So performance.
yeah, performance, absolutely. Perhaps another couple of comments. One point is on volatility. Volatility is very low for the asset class, right? So the stream of revenues or income has been stable, like we've been trading for 8 years, not a negative month. I mean, these things, they start to add up, you know, to compound in the eyes of investors at a time in which bonds have sometimes more volatility than equities. You know, so like, yes, it's true that at the margin, on certain market environments, in certain cohorts, you may have a public bond that may represent an alternative to yours that is trading a little bit higher than you. But what is the volatility of that bond in recent times? I mean, it's been outrageous, right? So institutional investors don't like volatility. Even right-way volatility at times. You know, if you buy a bond now with a 5-year duration, like Martin says, and it goes too quickly in the money, yes, it's good, it's great, we are making money, but the volatility is something else, you know, and the risk-adjusted return, there is one reason why we have sharp ratios, for example. And so this is point number one. And point number two that plays in favor of the asset class is it's a niche. It is real-world applications. I mean, it is the real economy, so it's huge, but the presence in institutional portfolios is small. Right, so there is this big disparity, right? So, like, yes, it's true that at the margin, at some points, there may be some alternative asset classes which yield a little bit more, or just not much lower anymore. But what about diversifying the portfolio across different things? And if the exposure of that asset class within portfolios is so small, is a tiny bit of those insurance portfolios, then there is still, you know, an argument to add to that exposure.
Yeah. Absolutely, but I also think that you mentioned a very interesting point. It should be big enough to move the needle for investors. And I think it's important to recognize that because I also feel that many investors, large insurance companies, I see that they want to start with a small basket and afterwards they become discouraged because it's too complex, legal costs and all this, they have headaches and they say, okay, it's not going to move the needle for me in the context of direct lending, let's leave it. So I think it's important to educate, to make to make them try and see the real benefits and not over pitching it. The transparency next to performance is also quite important here.
Yeah, I think there's also a responsibility at our end as well because there have been some reasonably large amounts of money put into our industry, into our sector. You know, we've recently done a big deal with a life insurer, and their whole concern throughout the deal was that the previous deal they'd done, the guys had not deployed the capital that had been allocated. And they just hadn't found the deals of the quality. And actually, when you dug into it, it's because the life insurer had come into the trade with a very specific set of requirements that didn't reflect what a real-world book of invoice would look like.
Yeah, very dangerous because you set yourself up for a failure to get a mandate that you cannot do.
Exactly right. But the problem with it, Gabriella, is if you actually go to any business in any industry, in any country in the world, they will do 90% of their business with 10% of their clients. So if you walk in and say, I want a portfolio where you don't have more than 3% exposure to any of your obligor, then you have to have more than one seller, more than one business you're dealing with. And in the ideal world of somebody like that insurer, we would have 50 sellers. But in the real world, if there's 50 sellers, there's 50 points of potential fraud. And because the credit insurance, God bless their souls, look after the credit side, we're earning a liquidity premium in the middle, but we're managing the fraud risk. I mean, and the bigger the companies you deal with, the less chance they're going to be a fraudulent company. But for some of the investors, they don't see that. They see that as a concentrated point, when actually it's the old Mark Twain theory, put all your eggs in one basket and watch that basket very closely. You're far better off with a number of very high quality sellers that you can manage, and I actually sit in the offices of all our sellers. I have a desk in each one of our cellars, in order to manage and guard the tone of those companies, rather than 50 sellers where, if I was lucky, I'd visit one a week, once a year.
Yeah. Now we mentioned a couple of very interesting themes here already. I would like to reach out to the audience. Do you have any questions, what you have heard so far, and are there relative value, attractiveness, how our panelists see the opportunities and risks?
You've got 2 questions on the...
Yeah, I don't see any, so it's okay. But
I'll ask them on behalf of the
thank you.
anonymous questioners. You've got to put your names on, please. What is preventing investors from investing in receivables finance? How do we address these obstacles? That's one question. The other one is, how are investors buying these investments? Notes, funds, white label product, etc. What is the demand right now?
I think we covered the first one. I think it's a question of education and shell shock after the recent movements. It's still a new sector. I disagree a bit with Sean that the Greensill book has reopened that wound. Actually, I find that investors are able to read it, understand what happened, and move on without me having to explain to them in the first half of every meeting.
Yeah.
So I think we're in a very good place going forward for investors coming in. So.
Yeah. The second one, we actually are flexible on the way we buy. For example, we even sign MRPAs with the big banks. We buy notes. Our preference is to buy a structured note from the asset originator, but we sign MRPAs as well, or the master risk participation agreement in BAFTA terminology. Jeff Wing was around here, who is the mastermind behind it. So we are fully flexible. Our investment grade funds, we call them utility funds, because basically we adjust to the originator. Because if in trade finance you don't adjust, you don't do business, basically.
But I think if I can just come in on that point, because just what Bertrand and Rick have said, I mean, there's a problem here of scalability. So Rick runs an excellent business, right? But if you are going to have to sit in, or you want to sit, I can understand why you want to do that in the office of every one of your sellers. You're going to have, you're going to have a scaling problem, and that is part of the issue. That another part of the scaling problem is how you buy in or distribute. So you've mentioned the BAFT MRPA, which properly should be called the BAFT for MRPA, because it was revised in 2018 to make it actually much closer to a true sale type of structure. But that is not. So we're looking at that again within it, because is that suitable for fund investors? They take a lot of fraud risk. We mentioned fraud risk a couple of times. They take the fraud risk. Will they do that? Is that something that's putting them off? It seems it is. And who should take that fraud risk? So
I don't think it's putting them off, Sean. I don't think they understand.
Well, they don't understand. So it's putting them off because they don't understand where it lies. And I think this is part of the problem.
With good practitioners in trade finance, the credit risk is very well managed, very well structured.
Correct.
So the actual real risk, underlying risk, will be fraud.
Yeah.
Yeah.
When you lose the share when there is fraud, our investors will lose money.
Which, if you know your counterparties, as Rick does, isn't going to happen. Because you know how reliable
it can happen perfectly. I know a gentleman who used to have dinner once a quarter with his wife, and the 2 owners of the company committed fraud.
Yeah.
Several billion-dollar fraud just a couple of years ago.
Can I ask you something on that? How do you attract investors, apart from performance, apart from explaining the opportunity, apart from being transparent? One of the aspects I hear all the time is alignment of interest. So what do you think about it? How do you create alignment of interest, risk sharing with investors, with your team?
But our investors are of multiple industries at the same time. In our funds, we have pension funds, insurance companies, financial institutions, family offices, private banking, individuals. So all of them have different requests.
But they all want to see skin in the game.
No, but alignment of interest comes not so much. So first of all, the alignment of interest comes by nature of going to an asset manager, because the asset manager, unlike the bank, unlike the structure of a note, has fiduciary duty in its regulation.
I have seen it long time, many times.
It not always works.
Especially when
Then
Show me the
the second point is, I mean, we are in a fixed income like return asset class, so we're not taking 20% of the upside like in a private equity fund. That's not the asset class for this. So that's not what we're doing, and I think it's also not the right way to address alignment of interest. One basic thing is, for instance, avoid investing equity into the sourcing partners, yeah, or avoid taking money from your investors and then giving loans to or financing to those entities that they own. I mean, all of this misalignment, just keep it very clean. Don't do that.
Any other ideas from the panel?
Transparency. It's one word. It's transparency.
Is it enough?
It is. I think if you can sit down with an investor and say, if you want to see what the fund owns, you can walk into our office and we will show you a list of every single receivable in the fund.
Yeah.
Okay.
We produce weekly risk management reports and credit reports. So.
But I think, again, this gets to the point about scalability. So how can you scale that up? And I think part of the answer to that is standardization. I know some of the brokers don't like that, but I think actually it is making the simplest possible asset and distributing it in the simplest possible way in a manner that's available, that's known to everybody. That I think is really important, because otherwise there's so many different ways of investing.
Why would that standardization come from the asset manager world on this panel, where 95 or 97% is produced and syndicated within the bank world, and they haven't done it for the last 50
that's
years.
exactly the point. I think the originators need to...
I'm a receiver.
I agree.
We're trading with 20 different sourcing partners, and we're just taking whatever is... The contracts are very flexible. We obviously want our conditions and so on, but we'll take what the market is offering us, and we're not going to reinvent, because we can't wait so long.
It's a lost battle.
It's a lost battle, exactly.
But it isn't just the funds, absolutely. It's the banks as well. So there has to be a way of doing it.
I think next time we will have a separate panel on standardization.
Or the factoring industry. Probably the banks.
Okay, we are running out of time, so 3 minutes we have. I would love to go through the panel from starting from right to left. Very briefly, what do you predict? What are your expectations for 2003?
In terms
apart
of
from standardization.
If you're talking about I think the wider trade finance market is, I think the quality end, as I said, the commodity traders and so on, that will hold up very well. I think a lot of the rest of the non-investment grade end, a lot of that, whether or not, as we said, the ICC, BCG survey has shown that is very low defaults. That's not just to commodity traders, that's to everybody. And that's because there's been government support. So if you're looking at the wider industry, what will happen in 2023? Governments are bust now. They spent it on COVID. They spent it on support for people with energy. So that's difficult. In terms of the fund managers, I think they'll still do very well.
Excellent. Francesco?
Well, 2023, I would expect a couple of things. One is repricing to happen for the asset class, at least in the way we define it. So like higher yields to reflect the changed economic environment and the interest rate environment. At the same time, I expect that to look to look good against public bonds, because perhaps public bond yields will be a little bit lower, spreads will be a little bit tighter or much tighter. And so at that point, whatever work we do now to reprice will come to fruition next year in very visible ways if this view on the market happens. And the second point is volatility. Again, we should look good for volatility reasons compared to public assets.
Excellent. Rick, just 3 words.
I think investors will come in, they get over what's happened the last couple of years. The industry has proved it does what it says on the tin over the last 12 months. I think we're in a very good place.
Excellent. So more track record, more investors.
Yeah.
I mean, track record of low volatility, track record of doing exactly what we said we were going to do when we set out, that we would provide those returns and we provide them in a certain fashion.
Yeah.
Yeah, repricing and growth, it will continue in our industry.
Yeah.
I see the downgrade cycle coming, and with that, I'm in the camp of Francesco, the repricing of margins going up. and I'm moderately bullish on investor inflows into the asset class, despite all the challenges and all the education and all the principal agent conflicts and so on. It's coming. It's not overnight. I once 5 years ago somebody said nothing happens overnight in trade finance, and I think that's true.
No, Rome wasn't made in one day. But if I would need to wrap up this panel, asking the question, what is attracting investor to invest in this asset class? You are not only an asset class, but you need to see yourself as a solution to a problem. So dialogue with an investor, what is the problem you are trying to solve? Is it a return? Then I need to put some leverage, or I need to structure something. Is it a liquidity? I have a solution. So it always starts with identifying how can I help my client? That's the most important question. What is the problem? How am I solving? What's the problem I'm solving? And if you do it in a transparent way, with strong alignment of interest, very clear transparency, authenticity, and great track record, I'm very, very positive that the potential of this asset class is tremendous to be a solution for a number of problems. Yeah, so I would like to close this on this note. That thank you for this very lively panel. I really enjoyed the interaction, and we wanted to make it a bit more interactive. So it's my fault, and please join me to thank the panel.